Hello and welcome to Fidelity Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lukasz. I'm Fidelity's global cross-asset specialist, and today I'm very pleased to be joined by Marty Dropkin, our head of Equities Asia Pacific. Welcome, Marty.
It's so great to be here. Hi, Lukasz.
Well, Marty, you've got a very interesting background. I know we had a bit of a chat, and you're originally was trying to work out which part of the States you're from, and you're actually from Tennessee, Elvis country. So how did a boy from Memphis go from to leading a equities franchise in Asia Pacific?
Yeah, well, so it's quite a long story, but not that long. So, and I promise you, I won't turn on a Southern accent for you because I'm not sure the listeners would want to hear me do that. But my dad was a stockbroker growing up in Memphis, Tennessee, and so I always kind of grew up in the house knowing what it was to be an equity investor and knowing about stocks. But I was a math and science kid when I was little. Yeah. I studied engineering. I did the whole thing. And I was in a job where I was traveling quite a bit. And I was literally gone like 8 to 10 months out of the year traveling. I was installing undersea fiber optic cables, in fact, for a big telecom company in the U.S., and my wife at one point said, because I got married in the middle of this job, she was like, "You got to grow up." She was like, "You're not traveling 8 to 10 months out of the year and staying married to me." And I loved her very much. So I went back to business school, and I ended up joining an equity research. Ended up joining in an equity research role, which felt very much home for me for my days in Memphis, Tennessee.
Yeah, absolutely. It's always interesting how different people find their paths, but that's great. That's a great story. Maybe if we sort of touch on some of the market-related things, because I think if there's a lot of things happening. We've got constant talk about inflation. Is it controlled? Is it not under control? There's geopolitics. There's a lot of things happening in markets at the moment. How do you sort of what's your take on the current environment?
I mean, it's a very interesting vantage point. So I'm an American guy who spent 11 years in the UK and now living in Singapore, managing Fidelity's Asia equity team. And, so it's an interesting juxtaposition of roles that I've been in and sort of a context that I have. But, kind of thinking about your question, Lukasz, and starting from the top, I think what's really driving and where we really kind of look at the disparity of the world, geopolitics you mentioned, and we can certainly come on to that, but I think it's the rates environment.
Yeah.
And if you look at what's happening in the U.S., where, we've gone from a very low, pretty much zero rate environment from years ago that obviously very rapidly increased, and now we're up around 5%. The market was anticipating that we might start to see rates coming down, and even last week with some interesting inflation prints. Now we're starting to see the market back off of that a little bit because inflation appears to be very persistent. And I think, the markets were anticipating a number of rate cuts by the Fed this year. That might or might not happen, or maybe we won't get as many as we were anticipating. I mean, it's kind of hard to tell at this point, but I think the Fed will be very data-driven. But that's the backdrop of the U.S., which is we've gone from zero to, I wouldn't call it high, but I'd call it medium. And, not high from an historical standpoint, but certainly high from a recent standpoint. But you compare that to what we're seeing in this part of the world. And by this part of the world, I don't mean Australia, I mean China, where we continue to see easing. Rates have gone from medium levels, and they continue to go lower. We're seeing China government bonds at very low levels compared to where U.S. Treasuries are. And not just China, but if you look across emerging market economies, other economies in Asia, we've seen inflation peaking and starting to come off. So I think the key thing to focus on if you're investing and you're trying to think about geographic allocations, particularly if you're thinking about the U.S. versus maybe Asia, is that disparity in rates. It is really stark, and I think we could be at a point where you're starting to see that differentiation come back in.
Yeah, absolutely, and then differentiation and dispersion is actually, from an investment perspective, becomes it's an interesting environment to be in because it certainly does pose opportunities. If we focus on China, and certainly from a client perspective, a lot of people talk about China. Obviously, from an Australian perspective, they're a main trading partner. Indirectly or directly, people may have exposure to China within their own investment portfolios or superannuation accounts. Now, China is at an interesting point because certainly we have seen the Chinese market sell off. We have seen some concerns more broadly around the Chinese economy. What are you seeing on the ground? Because we've got, I guess, a raft of analysts that are talking to companies every day. Those on the ground nuggets are really interesting. What are you seeing on the ground?
Yeah, look, we have a large team in China based in Shanghai. We cover a lot of stocks across our research team. And that's, for analysts based in Shanghai and Hong Kong. And even we have some in Singapore covering Chinese stocks. And so we get a real kind of, detailed look. And speaking to management teams, being on location, I think you do get a sense of where things are. Look, let me start by saying where I stand today. I'm reasonably sanguine about where we could go with the Chinese equity markets, and we've had, that's not to say we haven't had some tough times, right? We had 4 years in a row of disappointing returns for CSI 300 and that sort of broader, which is basically the Shanghai stock market and that broader kind of Chinese outlook, and so investors. I can totally understand how investors look at China and they think, wow, this has been weak. It's been tough. I just might continue to take a step back. But, the way you make money in markets is to take a contrarian view. And when everybody's turning negative, if you could figure out the right stocks to invest in and the right place to invest in and take the other side of that, that's where there's opportunities. And I think we're starting to see this turn. And if you look, we had a disappointing January in Chinese markets, but February started to improve and March has been pretty stable. April's been all right. So you've seen a 2024 where we started off, in a stronger point. And I'm talking a little bit more about markets and valuations, and we can move on to kind of where we're seeing fundamentals in a second, I know. But I think that sentiment is very important because we ended up in an environment where domestic investors and domestic Chinese investors themselves have been quite negative. And, you kind of think, well, if domestic investors are negative, you can understand how international investors might sort of feed off of that. But I've started to see a turn in domestic investors and their own sentiment. And so it's a little bit of a positive way to think about things. You ask about on the ground, I think, at least from a sentiment standpoint, that's what we've started to see. Yeah,
that's interesting because, we do get a lot of headline data in terms of macroeconomic data and the big picture. So that on the ground insight is very interesting. Any views on policy? Because we know the Chinese market is very driven by policy and there's been a lot of focus on what will the Chinese central bank, for example, do? Will there be stimulus? Will there not be stimulus? What is sort of the plan for the future go for? And we just had these 2 sessions meetings, which, the government there spoke around sort of, I guess, what the plan going forward is to meet their sort of 5% GDP number. What's your take on that?
Yeah, look, I think let's start with kind of the top level view, which is China is focused on growth. And I think regulators and domestic policy will be set around how it can achieve long-term growth. And look, China does think in terms of long-term. It's probably longer term in thinking than many of the Western markets that we look at, especially when you think about election cycles, which, the U.S. has to deal with and many other countries. China doesn't necessarily have that sort of dynamic. And so it is in a position where it can think long term. And it sets policy around that. So, whether it achieves 5% or plus or minus 5%, which is, I think, what came out of 2 sessions, is sort of around 5%, is a reasonable goal to me. And I think China has the levers to achieve that if it wants to. And so, it could be a little bit choppy as we go quarter by quarter, but that's not really the way policymakers think in China. They're looking for the long term and they're looking to see how they can do that. So that's sort of top level view. I think it's important to note, and I'm sure your listeners will be very aware of what China's gone through. And we had some real dislocation in the property sector, which is a very significant driver of the Chinese economy over the last 3 or 4 years. And we went from a property sector which was driven by growth and debt. A lot of people borrowed to buy property in China. And I think it became too much. And so the government has looked at that from a top level standpoint. And it's thinking, if we're going to build a sustainable economy, how do we diversify away from a property sector, which, depending on how you measure it, probably contributed anywhere from a quarter to, even to, by some metrics, over a third of growth in the Chinese economy. That's a lot driven by real estate in one sector. And if you look at the history of Japan, if you look at what happened at the U.S. during the GFC, I'm sure the Chinese government is thinking that's not exactly what we want to see.
Yeah.
So I think there's been a very deliberate attempt to, in a way, deflate the property sector, to think about how you can slow down that growth, limit the amount of debt that both consumers, both individuals and companies are taking on to drive that growth, and think about how it can diversify that economy into more innovative sectors. And happy to discuss where some of those are, we think. But I think all that kind of there's a lot of different drivers, but back to your question around growth, the government is very focused on growth. The components of that growth are likely to shift.
So one of the things you sort of briefly touched on is valuations. Now, at the moment, it's fair to say that most of the market thinks that the Chinese market looks relatively cheap to other markets, such as the US, for example. So it does. It looks cheap. But the question
is cheap.
Exactly. And we have seen an interesting sort of environment for the market where basically, certainly last year, you saw indiscriminate selling of the Chinese market, whether it was quality companies, whether it was poor quality companies. In that environment, everything sells off. So are we at a time, and you sort of mentioned there's a couple of positives now coming up, but from a bottom-up company perspective, are we starting to see some of those companies that have been sold off material, particularly the quality companies? Is that an area to start looking at, and it's becoming much more interesting?
It absolutely is, and that's exactly what we're doing. So, look, overall Chinese market is probably trading at around 8 or 9 times forward earnings, which is certainly cheap against the U.S., which I think, as we sit here today, is probably trading at 20 or 21 times forward earnings. So a huge disparity of those two markets. But by and large, if you look at China's historical valuations, it's also very cheap. So I think most investors on this podcast would say 8 or 9 times. Yeah, that's an attractive overall level of an entry point. But the devil's always in the details, isn't it? And so if you start to break that down, you think, well, why is it, trading at those levels? And as you said, there were some pretty aggressive sell-offs, and we had some earnings disappointments. And I think we were sort of in a period over a couple of years where, even if there was a slight disappointment, you saw stocks react very negatively to that. And there were days where, companies, large cap companies that might have slightly disappointed on earnings, down 20%, 25% in a single day after an earnings call. And sort of you look at that, and we're much more fundamentally driven, or I am at least, and most of our portfolio managers are. But it's also a market that you think like, do I really want to get aggressive in a market like that, or do I sort of wait for better entry points? And this is part of the reason I say I think we've kind of turned the corner, because we're not seeing as negative of a reaction now to some of those earnings disappointments. And you're always going to have some disappointments and some, outperformance in any particular earnings cycles. But we've also started to see better reactions when companies are beating. And so it creates that more sustainable environment. But what we are looking for, and what's happened through this 4-year period where we've had, as I mentioned earlier, this very disappointing performance in Chinese markets, that's left some companies that trade at really low valuations. And when I say really low, you've got some, sort of basic industrials companies, some cyclicals, which are trading at low single digit, and low single digit price earnings ratios, price to books well below 1, depending on the valuation metric to look at. Really, really good entry point. So our focus is thinking about, how do we look at sustainable cash flow? How do we look at sustainable earnings trajectory? And to sort of bite into some companies there to buy some companies and buy stocks that have those dynamics to them. And there's quite a few. And that's having the analysts on the ground to be able to do that work that gives you the confidence to be able to do that.
Yeah, absolutely. And it does sound like it's very much a you got to pick your battles, and it's very stock specific. So
Indeed.
Identifying those sort of those quality companies is very important. Maybe if we move on to another market which has sort of made a few headlines for different reasons, and that is Japan. So Japan, certainly in my time in markets, has sort of been this perennial sort of value market. Questions around whether some of those big companies are shareholder friendly, all of these sort of things. But Over the last couple of years, and we can see that in market performance over last year, I think Japan was one of the top, if not the top market performer last year. There is a bit of a shift, and it is creating a lot more interest in terms of the Japanese market. What are some of those changes that you're observing in that market?
Yeah.
And is it a tactical thing, or is there more of a structural theme to this?
I think it's very structural, and there's actually a personal sort of history here for me in Japan, because I, like many others, I decided to study Japanese, and I was in school in the 90s. And, it was sort of in the heyday of the Japanese markets, and it was the country that you thought, all right, if you're going to pick another country, and look, I grew up as a kid in the U.S., and almost thinking like, okay, Japanese cars are taking over. And I remember when the Japanese bought Rockefeller Center in New York, and it was like, Japan is where you have to focus your energy. Yep. And boy, did that all come crumbling down very quickly, right? With the property bust. And Japanese investors went through decades of just looking at disappointing equity returns. Does that sound familiar with what we've talked about with China now, right? And it was a very lengthy period where, every time there was a little bit of green shoots, it would just sort of back off. And Japan had a lot to work through. And I think what's happened there is a real shift in thinking, particularly about investor returns. And look, it links to sustainability, about how you create sustainable capital structures, and how shareholder returns link to that. And I think, this kind of goes back to Abenomics from some time ago, and how that kind of persists through the market. But there was a deliberate shift in thinking about how companies will return capital to shareholders. And as you know, there was a very tight holding for many years, the Keiretsu 2 system, where, shareholding was tight. And let's say perhaps there wasn't as much focus on returns. And that's shifted. So we've started to see dividend increases. We've started to see share buyback increases in Japan. And that's driven markets. And I think what's really been persistent is the investor confidence in that. I think that's really, really key. And that's what's going to drive valuations, right? If it happens once or twice, you might think, okay, it's a one-off. But if you start to see a trend and you start to see confidence around, government policy, then that will drive it. And so that's led to as you just highlighted, the good performance in Japan market. I think it continues. We're still at valuations which, by historical standards and on a relative basis, are attractive for Japan. I still think you have good earnings growth. I still think you have increasing dividends and increasing buybacks and return of capital to shareholders. So that's a trend that continues. And look, it also links to China. One of the things that's been driving China recently, and Chinese markets recently, is an increase in shareholder returns. And we can talk about that if you want, but particularly for state-owned companies who have produced KPIs for managers around shareholder returns, so that companies themselves are going to be motivated to do this. And I think there are similarities to Japan and China in that way.
Yeah, no doubt China would be looking at the history book and sort of looking at, trying to avoid that path that Japan went.
Definitely,
so it really sticks out.
Sure.
Yeah, absolutely. Is there anything else in the markets that we, if you think about the conversation over the last couple of years, it has been very focused on a couple of key themes, like inflation has been obviously central to that, and interest rates, obviously. What are we not talking about that we should be starting to think about?
I think we touched on quite a few things. We touched on geopolitics, and we touched on some of the kind of trajectories in various countries. You mentioned inflation, and that's probably the area that's likely to surprise one way or the other, and it's a really difficult one to call.
Yeah.
And we've gone through. Just let's think about it. In the last 12 months, we've gone from market, and we think about the U.S. We've gone from a market which is embedded, a sort of hard fall to perhaps a soft recovery, and now we're looking at a market which is basically saying everything is priced in well. how do you do that in a period of 12 months with that? But I think a lot of it is driven by inflation, both, sort of at the consumer level, both at the pricing level and at the wage level. And I think, what we're looking towards now is a market where we're thinking, well, inflation is a little bit more persistent in the U.S., but at the end of the day, it's a very difficult call to make. And so I can understand how the U.S. is a bit of a tougher call right now than perhaps some other markets where, it's quite clear that you've seen this deflationary, or I should maybe say disinflationary impact in some markets. And you can probably see that persist, but that dichotomy is something that I really pay attention to. I know we talked about it in a rates context, but also in an inflationary context, as that ties to real rates as well, is also important.
Brilliant. Well, Marty, thank you very much for taking the time. That's been fascinating, and safe travels.
Definitely. Well, thanks very much for having me.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform. Or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.